Welcome to Learn.Invest.Achieve channel and to the Apple Intrinsic Valuation video. In this video, we will know the intrinsic value of the Apple stock and why on November 3rd the stock price tanked to about 134. But before we dive deep, I want to mention that this video is not financial advice and is for entertainment purposes only. This is the 2022 Apple annual report that contains 2022 financial statements because Apple reports its operations on a fiscal year that ends on September 24th. So for Apple, it already finished its 2022 year, and we will forecast 2023 numbers and the intrinsic value of the stock based on those numbers. To perform this analysis, I go over the annual reports for the past few years that the company filed with the SEC, that is the Securities and Exchange Commission. The annual report or the 10K report contains financial and non-financial information that enables analysts to have an idea about what drive and influence the revenue, free cash flow per share, and conclude the fair value of the stock. So I want to show you quickly how to find these reports. So if you go to the SEC website and then click Company Filings, then enter the ticker symbol or the stock symbol, you will get to that company's page on the SEC website. And you can view all types of reports filed with the SEC as a requirement for the publicly traded companies. So I downloaded the annual reports for Apple from 2016 to 2022 and collected in this file the financial data that is essential to forecast 2023 revenue and free cash flow and put a price on the stock. The green cells represent data that is directly entered from the financial statements, and the blue cells are formulas to calculate ratios. So first, let's learn how Apple generates revenue and from where exactly. As you can see, Apple has 5 operating segments or 5 revenue streams, and they are iPhone, Mac computers, iPad, wearable home and accessories, and finally services. You see that the biggest revenue stream is iPhone, which is kind of scary thing because more than half of Apple's revenue depends on one product. But the good thing is that Apple is continuing to diversify its revenue to reduce the heavy weight that the iPhone has. Because in 2016, the iPhone made about 66% of Apple's revenue, which is definitely more than 52% of 2022 revenue. And when we look at the revenue from the geographical region's perspective, we find that the Americas makes 43% of 2022 revenue. Next is Europe, China, and then Japan. Next, we should check the revenue growth because it's a good indication of whether the customers are happy, returning, and the company can acquire new customers. And as we can see, the revenue is growing every year, which is something very satisfying. Now let's compare the revenue with the cost of revenue and operating expenses. We can see that the growth of the cost of revenue expense is matching the growth of the revenue, and the operating costs expenses are fairly stable, so we don't have to worry about gross margins. After that, we should check the debt because the debt and the ability to service the debt plays a huge role in deciding the risk of the company. And Apple's level of debt is stable, and it seems that the company is reducing its debt because in 2022, the debt to asset ratio is 31%, which is almost the same as in 2019 that was 30%. Here's another graph to better show the debt to assets ratio. And to measure if a company can service its debt and meet the interest expense payments, we use times interest earned ratio. And this ratio is simply showing how many times the interest expense Apple is making. Anything less than 7 is not recommended, which is not the case of Apple because in 2022 the company made about 45 times the interest expense. So in other words, we don't have to worry about Apple's ability to service their debt. The next exciting thing I learned from the financial statements is that Apple's determination to reduce the outstanding shares. As we can see in this graph, Apple is repurchasing some of their shares every year with an average of 3% per year because from 2016 to 2022, the company repurchased about 25% of their shares. This is an amazing news for the remaining shareholders because even if Apple's revenue and free cash flow doesn't increase, which we know it's not the case, the free cash flow per share and the earning per share will increase because of the shares buyback. We have another good news, especially for those who love dividends. Apple is a dividend company, and in 2022 the company distributed 90 cents per share, which I think is a very small amount compared to the stock price, but the dividend is increasing every year and it's expected to continue doing so. Now we can move on to the step where we can forecast 2023 revenue and free cash flow. Usually I use the working capital and the working capital to revenue ratio to forecast next year's revenue. But it is not working for Apple because the ratio is not consistent and because the working capital at the end of 2022 is a negative number. So I had to find some other factor that the revenue depends on. And I realized that the quality of the products is what attracts new users. And now we have it as an expectation from Apple that Apple products gets better with every new model. And I assume you agree with me if you're an iPhone or Mac computer user. In other words, quality is what drives the revenue. But how can I measure Apple's product's quality into a numerical number to use it to forecast the revenue? Going back to the financial statements, I found what I was looking for, and that is how much Apple spends on research and development decides the quality of the products, and that in turn decides the revenue. So I compared the revenue to the research and development expenses and realized that it ranged from 16.93 to 22.93. In other words, every research and development dollar generates around 17 to 23 revenue dollars. Therefore, I will use this ratio as a key to forecast the revenue, and to be conservative, I will use the lowest amount in the past 6 years, which is 16.93. The next piece that we need is the actual research and development expense in 2022, because this expense went to develop future products including the models that are going to be released in 2023, which will generate 2023 revenue. So far, we have what we need to forecast 2023 revenue, but now we need to decide how much of that revenue will be free cash flow. And to do that, we will use the free cash flow to revenue ratio. As we can see here, it ranges from 23% to 28%. So we will use the average ratio of the prior 3 years because the highest ratio was in 2022, and to be conservative, we shouldn't use that high ratio. Finally, we need to know the free cash flow per share, and to do that, we need to forecast 2023 outstanding shares. If we go back and look at the outstanding shares graph, it is obvious that Apple is reducing their outstanding shares every year. And over here we can see the actual percentage of decrease every year. So to be conservative, we should assume that Apple will only buy back 3% of its 2022 outstanding shares. The last two pieces of information are the required return on investment, or the ROI, and the discount rate. The return on investment percentage is different from one investor to another, but 5% is generally the minimum accepted return on investment. For the discount rate, we should use the interest rate earned on a 52 weeks United States Treasury bill debt security. And to find this interest rate, we should go to treasurydirect.gov, which is the official United States government website to buy or invest in the United States debt securities. Click on Treasury bills, then click here, and again over here. Then scroll down to the first 52 weeks to find the interest rate, which is 4.505%. The reason that we have to look up this interest rate in every video is that it keeps changing. So now we have all 6 keys to forecast 2023 numbers. And in my opinion, that will give us about 425 billion in revenue and about 116 billion in total free cash flow, which means $7.32 free cash flow per share. Discount that by 4.505% and use 5% as the required return on investment will give us 139.81 cents as a fair value for the Apple stock. And this is the reason why I think on November 3rd the stock price tanked to 134, because it seems that a major shareholder got the same intrinsic value as we just did and started dumping their shares before everyone else. Also, I want to mention that we were conservative in deciding the 6 forecast keys over here. So for example, if we change the research and development to revenue ratio to 18, then that will change the fair value of the stock to 148.64 cents. One last thing I want to mention, many thanks for those who subscribed recently, and if you didn't subscribe yet, please consider subscribing and liking this video to support this channel.